Good evening, traders. Today is August 14th, Thursday, and today I would like to introduce to you my new strategy, which I testing myself already for a couple of months. It's pretty successful, and I hope you will like it. So how you know we already have been using straddles as a main part of our strategies for options trading stocks, probably for 6 months already. It was pretty successful with limited risk, with a steady income, approximately from 2 to 4% per month. And that strategy was low touch. I hope you like it, and I hope I managed to dispel the myth that straddles are a risky strategy. It's actually quite the opposite. By selling straddles, we receive a much larger premium with fewer contracts. And as a result, we have lower risk compared to selling strangles or puts. So up till today, we using straddles have been using straddles with 30 to 60 days till expiration, but it is time to try them in short-term trading. For this, I think we good choice to use options on ES futures. We're gonna use 7 days till expiration. We will open it on Friday, tomorrow probably, and we'll continuously run it. And if it will be time, we will roll it to next Friday. I'll show you how we're gonna do that. So you can see on the here. So let me exclude protection. So here we use two straddles. I prefer one of them open right at the money, which is right now 64.70 call and put, and another one below the market at approximately delta 30 for put. So in this case, it's strike 6,400. So this is how structure look like. You can see that that structure has a pretty big negative delta. It's minus 29.5 right now. Yes, it's well protected. It's covering pretty wide interval. By the way, this is why I choose two straddles, because for 7 days till expiration, gamma is pretty high, and when it will be a swings up and down, we need to cover as wide interval as possible. So with just one pair of straddle, I don't think it's going to be possible. Well, it will be possible, but it will be much more work and much more stressful. So you can see that in our case, we covering interval from approximately 6,300 to 6,540. But as you know, that market usually going up, and we need some kind of protection when it will go up. So if you're familiar with our stock strategies like Crocs, which we use, we usually protect it with long duration calls, which is in our case the Lips call. It could be up to 1 year long. But in this case, we don't need to go so far because we just use weekly options. It's gonna be fine if we do it on monthly options. In our case, it is It is just a sec. I included 36 days till expiration. We can go a little bit more, but you know that I use for analysis option strat, but unfortunately they can't run at the same time options which related to two different futures contracts. So to show you how it's gonna look like together, I had to choose the option which is in this case just a sec. It's September 19th. It's the last expiration for the same future contract. But if you use OptionNet Explorer, you can use another expiration, maybe a little bit longer, up to 60 DT. But it's not a big difference. So if for stocks strategy, we usually use long call. In our case, because it's short term and we would like to preserve as much as possible time value, I think that it's a little bit more, it's a little bit better and more acceptable if we're gonna use protection as a call spread. So you can see that I open in our case two spreads, which long 64.50, little bit in the money, and sell 6600 strike call. So right now we have a total delta -3, virtually zero. Why I choose right now is a small negative delta, just because I think that market little bit overbought, but usually probably it's good idea to keep that delta a little bit positive. So for this we will probably run our long call a little bit lower, and we can see now it's positive delta, or we can increase amount of call spreads. For example, if we go to 3, so it will be delta +10, 9.5 in this case. So it's very flexible. So let's stick with that one which I choose. Two call spreads, and this is how that structure look like. You can see that it's pretty safe upside, because it's covering still up to 65.50 approximately, just for 1 week, and below break-even point at 63.67. So how we're gonna manage it? We will do the same way as we do our Croc strategy. So if market will go up, we just start rolling our short put up, and it depends how many days left till expiration. If it's beginning of the cycle, will be Monday or Tuesday, we're probably gonna roll that put the same expiration, same Friday expiration. But if it will be Wednesday, Thursday or Friday, probably we will roll it to next Friday. It's the same for calls. If we need to roll calls, we will do same expiration if it's beginning of the cycle. If it's end of cycle, we will roll to the next Friday. Also, we will roll to next Friday if, for example, if market went up and we roll our put, but our call will lose approximately 100% of time value. We don't need to hold it anymore. Probably we will roll it to next Friday and choose the strike acceptable for us by delta of position. So if, again, if market will go down, same thing, that we will wait till our calls will lose value, and if total position delta will be extremely positive, which is not acceptable, we will roll that call down same expiration, or we will roll it down and out to next Friday, but hold our puts until it will lose all-time value. After that, we will roll it to next cycle. So I would like to show you also boxing technique. So today we use just rolling technique, which mean that we usually close our short option and open the new one, probably higher if market going up, more expensive. This is what we name rolling. But boxing, it's a little bit different. I'll show you. Let me open the new one. Let's do a short call. Let's say that we sell, a short put, let's say we sell it for $41. So when market go up and our put lost at least 10 points in value, and it's time to roll it up, instead of closing it, we will buy another put, which is just $5 below the strike of our short put. In this case, it's 44.75. But if our 64.80 option lost value at least 10 points, it means that it will cost about 30. It means that 64.75 strikes probably gonna cost a couple of dollars less. So it's gonna be let's say 28. So if we buy it at 28, you can see that we box our short put and create no lose vertical. In worst case scenario, if market will close at expiration below that straddle, we still in profit, approximately $400. But if it will be above that, it will be more than $600 in profit. Is it a good strategy? Yes, it's good way to expand our profitability. And why we didn't use it before? Just because for long-term options, it's not very often you can get this kind of situation when your short puts or short calls lose so much value very quick. So in weekly auctions, because gamma is very high, just swings up and down will give us opportunity probably to open that boxes 3 or 4 times, and it will create a no-lose big structure, which is not 100% guarantee that it will finish at the maximum level and expand our profitability, but probability is high that it will happen this way, especially if we have more than one, and preferably from both sides of our position. I mean, we can box calls and we can box puts and create no-lose huge profit strangle, and it will expand our total profitability approximately a couple of more percent, which is pretty big if we can do it all the time. So I'll show you in practice how we're gonna do that. So it's nothing it's not hard. So again, instead of closing 64.80 and open new one, we will buy the put 5 points below. It's very important that options has a $5 strikes difference, because if it's gonna be 10, it will be already not as good and interesting for us than just $5 strike difference. So this is why, by the way, ES futures is quite good for that, and weekly options usually have strikes, $5 strikes. So this is how we're gonna run it, and again, to repeat, we will roll winning parts, roll same expiration or next Friday, next cycle, and keep losing parts until it will hold any kind of time value. As soon as it's lose time value, we will roll it also. And always will roll to different strikes to adjust our total position delta, which is acceptable for us. So what is expectation for this strategy? Well, it depends how market will be cooperative, but I expecting, it's hard to calculate just per week, because we will constantly roll it to next week. Better to calculate it for 4 cycles for 1 month. So I am expecting that total profitability will be between 10 to 20% per margin, at least. Worst case scenario, I expecting that it will be around 0. It's pretty hard in 4 cycles to lose from this strategy, unless it will be huge market collapse. It is possible, but what's our risks? In our case, we have only just 2 short puts, and we will continuously roll down our calls to make it cheaper and cheaper and cheaper, and finally we could be assigned with 2 long futures, which is will be at good price because of credit we constantly receive from put itself and from our calls, and we can easily handle, I guess, 2 futures just to will it out. This is how we gonna do that. And let me put it back to see how much profit we're gonna have. Just a sec. At short put, short call. Use it 64 and switch to calls. And we're gonna by protection, it's 64.50. Change expiration, we'll go all the way to September 19 and 6600, also change expiration. Yeah, this is how it's look like again. So you can see that maximum possible profit here, approximately 4,000 per week, but we're not expecting to make this amount of money. We will be happy to get constantly 1,000, from 1,000 to 2,000 per week from this structure, and if we do that, it's going to be from 5 probably to 8,000 dollars per month for 2 struggles right now, margin approximately 40,000. So it's gonna be from 10 to 20%, I believe, per month, which is very good profit. Yes, it need more attention. We will constantly monitor this, but profitability also much higher. So, guys, if you need some activity because our stocks positions it's low touch, kind of boring trading. If you would like some action, you can join me. But start it with small position, just two pairs of one each options right now. And oh, by the way, we have to add do it two verticals. Yeah. So we will see. And try it if you like it. We will continue to use it. And most important thing, with this kind of strategy, you just learn to handle your emotion. You learn to think quick what to do, and it's always gonna help in the future for longer term position. You won't be worried so much. Do it right and do it slow. Thank you very much, and see you tomorrow. And we will try to open this strategy, and we will see how it's going to work. Bye bye. Thank you very much.